According to the data, there are over 20 million millionaires in the United States and over 1.7 million millionaires in Canada as of 2022, which might actually seem like quite a bit, but what most people don't realize is that becoming a millionaire doesn't often look like what's portrayed in the movies. After all, being a millionaire doesn't come down to owning a brand new Porsche, it means having a net worth that exceeds $1 million in value. That is, having $1 million worth of cash, paper assets such as stocks, bonds, as well as exchange rate funds, or building equity or any type of asset equity, as well as anything else that tallies up to $1 million of value. Even a suit worn by George Washington, believe it or not. So in reality, while most people think becoming wealthy is synonymous with massive income levels, although that definitely helps, well, for most millionaires, that's not really the case. Instead, it's the fact of owning assets that have market value, appreciate over time, and create income for the owner of the asset that leads to the most everyday millionaires, as you're probably looking to achieve if you're watching this video. In fact, that's the very reason why 2.2 million new millionaires were created from 2019 to 2020, and in reality, even more have surfaced over the past 2 years with stock and real estate prices soaring to new heights. But not to worry, we'll be discussing in detail how you can implement both of these strategies into your own life in order to grow wealth over time. Hey, what's going on everyone? It's Griffin here, and in today's video I wanted to shed some light on some tactics and strategies that absolutely everyone can implement into their personal finances and investing, regardless of if you make $30,000 per year or $150,000 per year, in order to strive towards that $1 million nest egg that for many is the holy grail of personal finance goals. So with that said, we'll be looking at a couple of concrete ways that you can work towards that millionaire status while working your current job and not making a ton of money necessarily or becoming a hedge fund manager. Let's begin. Before we can speak about how to achieve high levels of wealth, we first need to consider one main factor that so many people seem to overlook, probably because it's just so simple, but that is control. Control over your financial habits and control over your savings rate, because unless you're starting a new company to one day liquidate it for millions of dollars in one swing, that's just not how the majority of the 25 million millionaires in North America achieved the milestone. Rather, it was years of consistency and control over their savings rate and investments. So although this sounds really simplistic, increasing your financial literacy and having better control over your income, expenses, and therefore your savings rate is paramount to achieving higher levels of wealth long term, because you're able to actually craft an investor mindset and put money away each and every month that has the time to grow and compound over years of investing. Always remember that control is what ultimately creates financial results. Money does not like to be ignored. Once you audit your personal finances and have a better understanding of how much income is coming into your accounts each month and how much is exiting to pay for your living expenses, well, at this point, one of the best ways to stay consistent with your investing is to remove all friction from the process possible through automating those investments. Now, I know this isn't anything new, but seriously, if you're part of the roughly 70% of the adult population in North America that's employed, then you have a very good idea of exactly how much money is coming into your account each month after accounting for deductions and taxation purposes. And so this makes it a lot easier to accurately plan how much you can put aside each month to your savings and your investments. Even if it's only say $50 a month to start, that's a great way to get into the right mindset and financial habits for once your income does grow down the line. Think of it, if you're not able to put $50 aside each month for your investments right now, then what makes you think that later on down the line when you're making say six figures, you're going to be putting a couple $1,000s a month into your investments? In fact, this is the exact reason why most lottery winners end up going broke, because they haven't crafted a proper investor mindset over years of consistency. And really, it's the consistency in those actions that lead to the most significant levels of compounded growth. Speaking of compounded growth, let's unpack the concept a little bit further. What most of these financial models striving towards $1 million net worth fail to consider is that they simply look at the nominal value being $1 million, rather than considering an inflation-adjusted value over time of what $1 million will represent over, say, 20-30 years, in contrast to what it represents right now. Because of course, $1 million in 2022 has a completely different purchasing power than $1 million back in, say, 1980, just as much as it'll have a completely different purchasing power down the line in, say, 2050. In 1980, $1 million was worth the equivalent of roughly $3.6 million today, and considering the the levels of inflation that we're seeing currently, it wouldn't be surprising if $1 million today had the equivalent purchasing power of over $2.5 million by 2050. So all this to say that while reaching $1 million net worth by the age of retirement is a fantastic financial goal to set for yourself, well, it's more about what the $1 million represents in purchasing power that ultimately matters. And so if you're in your 20s or 30s right now, creating a financial plan that actually strives towards achieving a net worth above $1 million is probably what you're ultimately after. Regardless, there are several ways to achieve this goal, all of which have to do with a combination of your income as well as your investment. So let's get into those right now. The simplest way for most people to start investing and getting their money to start working for them is to invest in low-cost exchange-traded funds on the stock market, which might sound boring because it is, but seriously, this is like the best course of action for over 95% of retail investors that aren't making investing their full-time gig. Even Warren Buffett agrees with this. Now, considering the fact that low-cost exchange-traded funds come in all shapes and sizes, well, it makes it difficult to accurately estimate how much you would need to invest each and every month to achieve a net worth exceeding $1 million, that is a portfolio value over $1 million by the age of 65. To simplify the example, let's consider the average yearly returns of one of the most popular ETFs available, being the SPY ETF that tracks the returns of the S&P 500 index. And even though this year's financial outlook is quite bleak, it has average yearly returns of 9.7% since inception in 1993, which seriously is really hard to achieve consistently over many years, even with an active investment approach. So considering these average yearly returns, someone starting to invest at the age of 25 over 40 years towards 65 years old would need to invest on average around $200 per month into this exchange traded fund in order to grow the value of that portfolio to an excess of $1 million. But of course, considering inflation and the fact that $1 million in today's value would be worth roughly in the waters of around $2.7 million in 40 years, well, you would need to invest on average, once again, around $525 per month to achieve that same level of purchasing power as the $1 million today. Okay, and what about if you're 35 watching this, meaning 30 years towards that 65-year-old retirement goal? Well, again, considering the average yearly returns of the SPY ETF being around 9.7% since inception, you would need to invest on average around $520 per month to achieve the portfolio value of around $1 million. And considering inflation and the fact that $1 million today would be worth roughly $2.1 million in 30 years, well, you would need to invest on average around $1,050 per month to achieve that same level of purchasing power in 30 years as the $1 million today. Now, keep in mind, retirement is really nothing more than a state in which you've achieved financial independence through your assets generating enough income each and every month to fully cover and pay for your living expenses. And so while it's fantastic to set a goal of achieving a net worth of, say, $1 million by 65, this is really nothing more than just that, a goal, and doesn't necessarily reflect over the realities of true financial independence. I really just wanted to make that clear. What we can take out of the previous examples, though, is that the later on in life that you start implementing an investment strategy, the more catching up you need to do because you have less time to take advantage of compounded investment returns. Now, if you are going to achieve millionaire status by investing in the stock market, you need to also consider the financial implications of Big Brother's hand in your pocket, because taxes will severely impact your progress towards wealth. So this is where tax-sheltered investment accounts such as the TFSA and RRSP in Canada, as well as the IRA and Roth IRA in the United States, come into play. Essentially, the TFSA and Roth IRA allow the value of your investment portfolio, as well as any dividend income that you're generating within the portfolio, to grow completely tax-free. So those $1 million investment portfolios that we just looked over wouldn't be subject to any taxes when it comes time to start withdrawing funds from the accounts, say 20, 30, or 40 years down the line. That being said, these accounts do have annual contribution limits, often the equivalent of around $500 per month. So depending on your current age, you may or may not be able to fully achieve your net worth goal on a tax-free basis, just something to consider. Speaking of investing, I'd now like to take the opportunity to speak about today's video sponsor, Newton Crypto, which is a low-cost, commission-free crypto trading platform that I personally use to buy and sell my crypto assets, so this integrated perfectly with my messaging. Now, the reason why I personally use Newton is mainly because of their fee structure, where they don't charge any funding or withdrawal fees whatsoever. Plus, since Newton has access to high liquidity levels, the spread on their crypto prices are very low compared to other platforms that I've looked at. What's even better is that they offer by far one of the largest selections of digital assets available to trade at over 70 cryptos, and when you're ready to withdraw to your offline wallet or send someone else crypto, Newton covers the first $5 in network transaction fees, which is awesome, especially for small crypto transactions. So let's say you wanted to buy $50 worth of Bitcoin. You can easily deposit funds into your Newton account via e-transfer, which makes things really simple. And then purchasing Bitcoin simply comes down to placing an order. So in this case, we can put a maximum of $50 and you can place either a market or a limit order. In this case, we'll just be putting a market order in, previewing the order, and then swiping to confirm. It's as simple as that. From here, we can easily withdraw our crypto to offline wallets by clicking transfer crypto to wallet and then inputting your wallet address. In this case, we're going to withdraw the maximum amount, send withdrawal request, and we can see that the estimated network fees are entirely covered by Newton in this case because they are less than $5. And once again, this is a game changer because this could literally represent 10% with other platforms without even taking into account any other fees charged. So if you're ready to start trading crypto with some of the lowest fees, make sure to check out Newton Crypto today using the link down below in the description. You can get $25 for free on sign up when you trade your first $100 worth of crypto on Newton. Step number 2 of becoming an everyday millionaire has to do with more than just socking away a couple $100s each month into the stock market, which for most people isn't going to be the case anyways. Most people aspire to, at some point in their lives, become homeowners and potentially even real estate investors, owning a couple more rental properties in order to further compound the growth of their investments. But I'll leave the real estate investing topics for another video, or you can take a look at all of the videos I've already made on the channel in my real estate investing playlist. In this video specifically, we'll be concentrating on the financial effects of even just owning one single property. The thing is, regardless of what you might have come to believe by watching videos online of people touting the benefits of renting long term, well, the data around net worth for renters versus owners is undeniably favorable towards owners. In fact, as we can see right here, the data shows that the median net worth in the US of a renter was only $6,300, whereas the net worth of a homeowner was $255,000, and that was in 2019. Over the course of the past couple of years, this gap would have become even larger. Now, before I get people commenting down below the fact that I'm wrong, well, the main reason backing up this data is that while on paper, sure, depending on the area that you're living in, it can often make more financial sense to rent versus own on a month-to-month cash flow standpoint. Well, that's not necessarily a reasonable way of looking at things. So like, here's the thing. I've seen many videos online where an individual will look at the costs of owning versus renting long term, and on a month-to-month cash flow standpoint, they might be able to save an extra $100 or $200 per month that they can put into stock market investments. But the thing is, humans tend to overestimate their capacity to actually invest that excess cash flow every single month into, say, the stock market, not over a 12-month period, no, over many decades required to actually make that strategy worthwhile in the first place, versus missing a mortgage payment comes with significantly larger financial consequences. In addition to this, most millionaires are actually created through property equity, not through investing in the stock market, and believe it or not through trust funds. That's right, simply purchasing one property and paying it down over several decades while it also appreciates in value, both of which positively impact your net worth. Now, of course, property values have been on a crazy roller coaster ride since the beginning of the pandemic, and that was very much unsustainable, as we've spoken about many times on the channel, and we are seeing property prices coming down quite a bit. But even considering just the average annual property appreciation rate of around 4% per year, that's huge over several decades, especially considering the fact that most individuals are leveraging up their down payment, putting up only, say, 20% of the property's value to purchase it upfront. Here's a quick example. So most mortgages here in Canada are over 25 years. So considering someone purchased their home in 1997, it would be paid off as of this year. And the average home prices back in 1997, where I'm from at least, were $144,000, as we can see from this chart. Fast forward to today, it now sits at around $600,000, meaning right there you would have a net worth exceeding $600,000 without any other investments whatsoever. That's simply paying down your house over the 25-year period and thus fully eliminating your largest monthly expense. And really what a lot of people fail to consider is that although every single scenario of looking at being a homeowner versus renting has a million different variables depending on where you live, the average price of rent, the average price of properties, how much you're going to be spending on maintenance is going to differ from one property to another. But over, say, that 25-year period, average rents are also increasing by 4 or 5% per year. So over the course of 25 years, the rents will more than triple in value, whereas you've spent your time paying off the home, and after 25 years, your mortgage payment is zero. So you're simply paying your property taxes and a couple other expenses in order to live. And it's been a while since I pulled up this chart on the channel that I love just so dearly, but it really showcases the power of owning a property towards your net worth when you have a net worth below $1 million, where we can see right here that the home equity of the primary residence represents typically a very large portion of most individuals' net worth that hovers around $1 million. Now, with that said, right now the average age of first-time homebuyers is 36 years old. So first of all, if you're not there right now, don't worry, you're not alone, seriously. But aspiring to save up towards that first down payment in order to become a homeowner is, typically speaking, going to be one of the best financial decisions that the average individual makes in their life. And with low down payment options of 5% down on an owner-occupant loan, there are many options available to make homeownership more feasible for the average person. But even if you're 36 years old right now and have just purchased your first home this year in 2022, well, considering the average home price that we just looked at in the previous example, well, considering another 29 years of growth towards the age of 65 at an average 4% annual growth rate, that home would be paid off and worth roughly $1.8 million. And hey, make that a rental property, you're not even paying for any of the property's expenses, the tenants are. So essentially what I'm trying to get at in today's video is that a mixed approach to your investment portfolio is generally going to be the best course of action through property ownership, maybe a single family home, well, any type of personal use property that you're actually living in, potentially purchasing one or two other rental properties, and also investing consistently in the stock market through mainly low-cost exchange traded funds and quality dividend stocks. That is really a great first step that you can start implementing in your personal finances and investments to gain long-term financial success. If you want to learn more about how to properly invest in the stock market specifically, I would highly recommend that you check out my 2 stock market investing courses that are free on Skillshare, one of which is brand new, all about dividend growth investing, and the other one is about everything you need to know to properly navigate the stock market and craft a portfolio suitable for your needs as an investor. Again, both of them are free on a 1-month trial of Skillshare. You can find those down below in the description. And if you want to learn more about real estate investing, I would also highly recommend that you check out my full wealth through real estate investing course that you can find over on Udemy. I cover everything that I personally do in my own real estate business to scale it up over the past 4 years from one single duplex to now over 15 properties. So if you're interested in that, also check that out. Thanks again to Newton for sponsoring today's video. And on that note, drop a like if you enjoyed the video, comment down below, and I will see you in the next one.